The silver market has just entered a phase that very few investors truly understand. A major move out of China is sending shockwaves through the global precious metals market, and the consequences could be far bigger than most people expect. While mainstream headlines remain focused elsewhere, the smart money is watching silver more closely than ever. In today's discussion, we'll break down what China's latest decision could mean for supply, demand, price discovery, and why this may become one of the most important turning points for silver investors. If you're holding silver or thinking about buying it, you need to understand what's happening before the market makes its next move. For years, the global silver market has operated on a delicate balance between industrial demand, investment demand, mining production, and government policies. Every once in a while, a single event emerges that forces investors to reconsider everything they thought they knew. China's latest move has become one of those events. While many people only see a headline or hear a brief mention on financial news, experienced market participants understand that major shifts rarely announce themselves with flashing lights. Instead, they begin quietly with policy changes, regulatory adjustments, shifts in imports and exports, or decisions that gradually reshape the flow of precious metals around the world. China is not just another participant in the silver market. It is one of the largest industrial economies on the planet and one of the biggest consumers of silver for manufacturing. From electronics and solar panels to advanced technology and electric vehicles, silver plays an essential role in countless industries that continue expanding every year. Whenever China changes its approach toward commodities or precious metals, investors everywhere pay attention because those decisions can influence supply chains across multiple continents. The importance of China's position cannot be overstated. The country has spent decades building manufacturing capabilities that depend heavily on reliable access to raw materials. Silver has become increasingly valuable because modern technology requires exceptional electrical conductivity, corrosion resistance, and efficiency. These unique properties make silver difficult to replace in many industrial applications. As new technologies continue to develop, the demand for silver becomes increasingly tied to long-term economic growth rather than short-term speculation. Many investors focus almost exclusively on interest rates, inflation reports, or central bank announcements while overlooking structural changes taking place inside the world's largest manufacturing economies. This creates opportunities for those willing to look beneath the surface. Market prices often react long after the underlying fundamentals have already begun changing. By the time headlines become widespread, experienced investors have frequently positioned themselves well in advance. Whenever governments introduce new regulations or adjust policies affecting commodities, markets begin recalculating future expectations. Investors start asking difficult questions. Will supply become tighter? Will industrial users begin stockpiling? Could exports decline? Might domestic consumption increase? These questions matter because commodity markets are driven not only by current availability, but also by expectations about future availability. One reason this development has attracted so much attention is because uncertainty itself influences investor behavior. Financial markets dislike uncertainty. Whenever uncertainty increases, volatility often follows. Traders begin adjusting positions, institutions reassess risk exposure, and manufacturers reconsider purchasing strategies. Even before actual shortages appear, expectations alone can influence pricing dynamics across global exchanges. China's influence extends far beyond its own borders. Decisions made within Beijing can affect miners in South America, refiners in Europe, manufacturers in Asia, investors in North America, and bullion dealers around the world. Modern commodity markets are deeply interconnected. A change in one region quickly ripples through international trade networks, affecting transportation, inventories, pricing models, and investment strategies. Experienced precious metals investors understand that silver differs significantly from gold. Gold is held primarily as a monetary asset and store of wealth. Silver, on the other hand, occupies two worlds simultaneously. It serves as both an industrial metal and a precious metal. This dual identity makes silver particularly sensitive to economic changes. Strong industrial demand supports long-term consumption, while investment demand can amplify price movements during periods of uncertainty. As manufacturing technologies continue advancing, silver consumption has expanded into industries that barely existed a generation ago. Solar energy installations require substantial amounts of silver. Electric vehicles depend on sophisticated electrical systems that incorporate silver components. Data centers, telecommunications equipment, medical devices, aerospace technology, and semiconductor manufacturing all consume significant quantities of silver. These trends suggest that industrial demand is becoming increasingly diversified rather than concentrated in a single sector. Investors often underestimate how difficult it can be to rapidly increase silver production. Mining projects require years of exploration, environmental approvals, financing, construction, and operational development before new output reaches the market. Even when prices rise sharply, additional supply cannot simply appear overnight. This lag between higher demand and increased production frequently contributes to periods of tighter market conditions. Another important consideration involves the fact that much of the world's silver production comes as a byproduct of mining other metals such as copper, lead, and zinc. This means silver supply does not always respond directly to silver prices. Even if silver becomes more valuable, production depends heavily on the economics of other mining operations. This structural characteristic creates unique challenges for balancing supply and demand. Whenever a major economy changes its approach toward strategic commodities, institutional investors begin reassessing their long-term assumptions. Pension funds, hedge funds, sovereign wealth funds, commodity specialists, and large asset managers constantly evaluate geopolitical developments that may influence future resource availability. They recognize that policy decisions today may shape market conditions for years rather than weeks. Retail investors frequently arrive much later because they rely primarily on mainstream news coverage. By the time television networks devote extensive attention to precious metals, substantial price movements may have already occurred. This timing difference explains why professional investors spend significant resources monitoring regulatory announcements, trade policies, import statistics, and industrial production trends rather than waiting for popular media narratives. The silver market has historically experienced periods where relatively small changes in physical availability resulted in disproportionately large price movements. Unlike many larger commodity markets, silver can be particularly sensitive when investment demand accelerates alongside strong industrial consumption. Since above ground inventories available for immediate delivery may be more limited than many people realize, sudden increases in buying activity can create noticeable market stress. Confidence also plays a significant role in commodity markets. If manufacturers believe future supplies could become less certain, they may increase inventory purchases to secure production schedules. This behavior itself increases current demand, placing additional pressure on available supplies. Similar dynamics occur among investors who seek physical ownership rather than paper exposure during periods of heightened uncertainty. China's economic planning often emphasizes long-term strategic objectives rather than short-term market reactions. This perspective differs from many Western financial markets, where quarterly results frequently dominate investment decisions. Long-term resource security has remained an important theme within China's industrial development strategy for many years. Consequently, market participants carefully evaluate any policy adjustments involving critical raw materials. Global trade relationships have also become increasingly complex. Supply chains continue evolving as countries seek greater resilience following disruptions experienced over recent years. Governments and corporations alike have become more aware of vulnerabilities associated with concentrated production and transportation networks. Precious metals naturally become part of these broader strategic discussions because they remain essential for advanced manufacturing. Inflation concerns add another layer to the silver story. Historically, many investors view precious metals as potential stores of value during periods of declining purchasing power. While gold typically receives most public attention, silver has often demonstrated stronger percentage price movements during precious metals bull markets because of its smaller market size and dual industrial role. Industrial demand continues expanding in areas aligned with global energy transition initiatives. Solar panel installations have increased dramatically across numerous countries. Renewable energy infrastructure relies heavily on silver due to its unmatched electrical conductivity. Even incremental improvements in technology often require maintaining or enhancing performance standards that favor silver usage despite ongoing efforts to reduce material costs. One misconception among newer investors involves assuming that technological progress automatically reduces silver demand. In reality, while manufacturers constantly seek efficiency improvements, overall production volumes have expanded sufficiently to offset many reductions in per-unit silver usage. As billions of electronic devices continue entering global markets, aggregate demand remains substantial. Another factor worth understanding involves investor psychology. Financial markets frequently oscillate between complacency and urgency. During quiet periods, commodities may receive limited attention despite improving fundamentals. Then, a catalyst suddenly changes sentiment, attracting significant capital flows within a relatively short period. Those who studied market conditions beforehand often find themselves better prepared than those reacting emotionally to headlines. Professional analysts examine inventory reports, refining capacity, mining output, fabrication demand, exchange warehouse stocks, import data, export trends, and industrial purchasing patterns together rather than focusing on any single statistic. Markets rarely move because of one isolated factor. Instead, multiple developments gradually align until participants recognize that underlying conditions have fundamentally shifted. Silver's relatively small market capitalization compared to many financial assets also contributes to its potential volatility. It requires significantly less investment capital to influence silver prices than larger equity or bond markets. Consequently, even modest reallocations by institutional investors can have noticeable effects under certain market conditions. Historical cycles demonstrate that commodities often remain undervalued for extended periods before entering phases of rapid price discovery. During those transitions, narratives shift quickly. Assets once considered overlooked suddenly dominate financial discussions. Investors who previously ignored precious metals begin seeking exposure precisely when prices have already advanced substantially. Understanding China's role, therefore, requires looking beyond immediate headlines. The broader issue concerns how strategic decisions by one of the world's largest economic powers influence confidence, expectations, and long-term resource planning throughout the global economy, whether through policy adjustments, industrial priorities, or trade decisions. China's actions inevitably become part of the larger conversation surrounding silver's future. Experienced market observers know that the most important developments rarely appear dramatic at first glance. Instead, they unfold gradually as data accumulates, market participants adjust expectations, and institutional behavior begins changing beneath the surface. Careful investors pay attention not because every headline guarantees immediate price increases, but because significant trends often begin with subtle shifts that later prove far more consequential than initially recognized. This is precisely why developments involving China continue attracting close scrutiny from analysts who specialize in precious metals. Rather than reacting emotionally to every news cycle, they examine how each decision fits within broader patterns of industrial demand, geopolitical strategy, resource security, manufacturing growth, and long-term investment behavior, recognizing that the silver market has historically rewarded those who understand structural change long before it becomes obvious to the wider investing public. When discussing the global silver market, one of the most important concepts to understand is supply. While many investors focus almost entirely on price charts and daily market fluctuations, the real foundation of every commodity market lies in the balance between supply and demand. If supply begins to tighten while demand remains steady or continues to grow, the market naturally becomes more sensitive to price increases. That is why any development affecting the global silver supply deserves close attention, especially when it involves one of the world's largest economies. Silver is unlike many financial assets because it is a physical commodity. Every ounce that enters the market must first be discovered, mined, processed, refined, transported, and delivered before it reaches manufacturers, investors, or industrial users. This entire process requires years of planning, billions of dollars in investment, skilled labor, specialized equipment, and stable geopolitical conditions. Unlike currencies that can be created electronically or stocks that can be issued by corporations, physical silver cannot simply be produced on demand whenever prices begin rising. One of the biggest misconceptions among new investors is the belief that higher prices automatically result in more silver entering the market. In reality, mining does not operate that way. Opening a new silver mine is one of the longest and most expensive projects in the natural resource industry. Before production even begins, companies must conduct geological surveys, secure land rights, complete environmental studies, obtain government permits, arrange financing, build infrastructure, purchase heavy equipment, hire workers, and establish transportation networks. In many parts of the world, this process can take several years before the first ounce of silver is produced. Even existing mines cannot always increase production quickly. Every mining operation has physical limitations determined by equipment capacity or quality, labor availability, to environmental regulations and operational costs. Running equipment beyond safe limits can increase maintenance expenses, reduce efficiency, and create safety risks. As a result, supply often remains relatively fixed over the short term, regardless of sudden increases in market demand. Another factor that makes silver unique is that a significant percentage of global production comes as a byproduct of mining other metals. Large quantities of silver are recovered during the production of copper, lead, zinc, and gold. This means many mining companies are not primarily focused on silver itself. Their production decisions depend more heavily on the economics of the main metal they are extracting than on the current silver price. For example, if a copper mine experiences lower copper prices and decides to reduce operations, silver production from that mine also declines even if silver prices remain strong. This creates an unusual situation where silver supply is partially controlled by market conditions in entirely different metals. Investors who only monitor silver prices may overlook these indirect influences on global production. The quality of available ore also affects future supply. Over many decades, some of the highest grade silver deposits have already been mined. Many newer mining projects must process larger amounts of rock to recover the same quantity of silver. Lower ore grades increase production costs because companies consume more fuel, electricity, water, chemicals, and labor for each ounce produced. As mining becomes more complex, maintaining previous production levels becomes increasingly expensive. Environmental regulations also play an important role. Around the world, governments have strengthened environmental standards governing mining activities. Companies must now comply with stricter requirements related to water management, waste disposal, emissions control, land rehabilitation, and community engagement. While these regulations help protect ecosystems and local populations, they also increase project costs and extend development timelines. Political stability represents another major consideration. Many of the world's largest silver producing regions experience periodic political uncertainty, labor disputes, tax changes, or regulatory reforms. Even temporary disruptions can reduce production and delay shipments. When investors evaluate long-term supply trends, they consider not only geological resources, but also the political environments where those resources are located. Transportation networks have become another critical factor in recent years. Mining operations depend on reliable roads, railways, ports, shipping companies, and fuel supplies. Disruptions affecting any part of this chain can slow deliveries to refiners and manufacturers. Global supply chains have demonstrated how interconnected commodity markets truly are. Delays occurring thousands of miles away can eventually influence inventories available to industrial users around the world. China enters this picture from multiple directions. As one of the world's largest manufacturing nations, China consumes enormous amounts of silver every year. The country also participates in mining, refining, importing, exporting, and industrial fabrication. Because of its central role within global manufacturing, any policy changes affecting China's silver market naturally attract international attention. If China adjusts import policies, increases domestic consumption, modifies industrial priorities, encourages stockpiling, or alters export regulations, these actions can influence how much silver becomes available to the rest of the world. Even relatively small policy adjustments can reshape international trade flows because of the sheer scale of China's industrial economy. Industrial demand continues expanding as modern technologies become increasingly dependent on silver. Solar panels remain one of the fastest growing sources of consumption. Silver's unmatched electrical conductivity makes it extremely valuable for photovoltaic cells that convert sunlight into electricity. As governments continue investing in renewable energy infrastructure, demand from the solar industry has steadily increased. Electric vehicles represent another growing source of silver consumption. Compared with traditional automobiles, electric vehicles require more sophisticated electrical systems, advanced sensors, charging components, and electronic controls. Many of these systems utilize silver because of its reliability and superior conductive properties. As electric vehicle production expands worldwide, industrial demand for silver continues growing alongside it. Consumer electronics also remain an important driver of silver usage. Smartphones, computers, tablets, televisions, wearable devices, networking equipment, and countless electronic components contain small quantities of silver. While each individual device uses relatively little metal, billions of units are manufactured every year, creating substantial cumulative demand. Medical technology has also increased silver consumption. Silver possesses natural antimicrobial properties that make it valuable in wound care products, medical equipment, surgical instruments, water purification systems, and specialized healthcare applications. As medical technologies continue advancing, additional uses for silver continue emerging across healthcare industries. The aerospace and defense sectors also rely on silver for specialized electrical systems capable of operating under extreme conditions. Aircraft, satellites, communication systems, navigation equipment, and advanced military technologies frequently incorporate silver because of its durability and conductivity. These industries prioritize performance and reliability over material cost, making silver difficult to substitute. One important aspect of commodity markets involves inventories. Not all silver produced each year immediately enters industrial consumption. Some remains stored in vaults, exchange warehouses, government reserves, or private investment holdings. However, not every ounce held above ground is available for immediate sale. Many investors purchase physical silver with long-term intentions and have little interest in selling during periods of uncertainty. When physical inventories become concentrated among long-term holders, the amount of metal actively circulating within the market can become significantly smaller than total above ground estimates might suggest. This distinction between total supply and available supply becomes particularly important during periods of rising demand. Institutional investors pay close attention to warehouse inventories because declining stocks sometimes indicate stronger physical demand than paper market activity alone might suggest. Although inventory movements require careful interpretation, persistent reductions over extended periods can signal tightening market conditions. Another important consideration involves refining capacity. Raw silver extracted from mines often requires additional processing before reaching commercial purity standards. Refining facilities must possess adequate capacity to process concentrates efficiently. Bottlenecks within refining infrastructure can temporarily limit the availability of finished silver products, even when mining output remains stable. Energy prices also influence silver production costs. Mining operations consume substantial amounts of electricity, diesel fuel, explosives, chemicals, and transportation services. Rising energy costs increase production expenses throughout the mining industry. If operating costs rise faster than silver prices, some higher cost mines may reduce output or postpone expansion projects. Inflation has created additional challenges across the mining sector. Labor costs, equipment prices, replacement parts, maintenance expenses, construction materials, and financing costs have increased in many regions. Mining companies must carefully balance profitability with production objectives while managing these rising operational expenses. Currency fluctuations introduce another layer of complexity. Since silver is typically priced in US dollars, while production costs occur in various local currencies, exchange rate movements can significantly affect mining profitability. Strong or weak currencies influence investment decisions, exploration budgets, and expansion plans across different producing countries. Exploration remains essential for future supply. Every producing mine eventually experiences declining reserves unless new discoveries replace depleted resources.